Hey, if you're looking to create a cash flow projection for an existing school and you're running into trouble because it's a complicated process with cash inflows coming in lumps when tuition comes in, and then cash outflows going out throughout the year for teacher salaries and operating expenses, and you need to try to predict and forecast what cash flow is going to look like, you've come to the right place, because we have built a financial projection or cash flow forecast template here built specifically for existing schools. And I'm going to walk you through it. There's a little bit of complexity here, but I'm going to walk you through it and show you how to fill it out and show you how hopefully it will help you be able to better predict and manage cash flow for your school. Now, I'm going to put a link to the template down in the description of the video below. And if you stick around to the end of the video, I'm also going to provide a coupon code, give you access to a coupon code so you can get a discount during checkout when you go ahead and purchase this template to use for your school. Before I dive into the details of the template, my name's Adam Huxema. I'm the co-founder of ProjectionHub. And over the last decade, I've helped over 50,000 entrepreneurs create financial projections for potential investors and lenders and for internal cash flow forecasting. And so that's really what we're focused on here today for an existing private school. And so with that, let's go ahead and dive in. All right, so we are starting on the at a glance tab, and this is kind of the end of the process. So after you have created all of your, filled out all of your assumptions, put in your projections, and you will be able to see this nice at a glance tab. You know, one of the things we'll get to see kind of right off the bat here is this kind of funny graph where we see revenue, sales forecast revenue, and then it takes these big dips, and that's kind of, again, related to the timing of income and taking the summers off and for a school, and also the cash generated. It's also kind of funny, right? So we'll see, you know, starting cash, and then it goes down and down, and then you get a big influx of tuition, and then you kind of drain that down again, and another big influx of tuition. And so that is one of the challenges that schools have in trying to forecast and manage cash flow. And so we get to see some of that here based on the data I've already filled in. You're also going to get a 5-year income statement summary, a 5-year cash flow summary, 5-year balance sheet forecast summary, and then an income statement, cash flow, and balance sheet broken down by month for each of the 5 years. So you can see, what months you're profitable, what months you're cash flow positive or negative, and just, keep an eye on here on the cash flow template or cash flow report. We can see, cash at the beginning and end of each period, just to make sure that you still have cash in the bank at the end of the semester before the next round of tuition comes in. All right, so with that, let's go ahead and dive in to the input tab. So I'm on the input assumptions tab here. And what you can do is any cell that's highlighted in blue is an assumption that you can change. And so we can say, all right, we're going to start in January of 2023, and we have $1 million in cash in the bank. Maybe tuition just came in, so we've got cash in the bank here. And we can put in some funding sources other than loans. So if you have some grant funding, you could put grant funds in here. We also get to say what percentage of our accounts payable do we pay in the month incurred versus on a delay. If you have terms with any of your vendors, you can pay that on a delay. Let's look at the fixed assets. So you can put in your existing fixed assets if you have on your balance sheet, and then the existing current accumulated depreciation. So again, you want to pull your balance sheet, and you could, if you're an existing school, and put in these numbers, the value and the depreciation amount for each of your fixed assets into the model here. Now you also have the ability to, I should mention here, so for assets that are already on the balance sheet, that are already existing, you want to put month 0 here. Now for assets that you intend to purchase in the future and you want to forecast that, you can put month 1 or any month into the future. Let's say we're going to buy new computers in a year, we could put month 12 there to signify that. And we can also add in existing loans and future loans that we think we might take out. All right, now on the input revenue tab, what you'll want to do is put in the different revenue categories that you have. And so what we did was just assume that we have these 4 different revenue categories that we're categorizing as kind of the stage of the school, so preschool through high school, and breaking those down by category. You can also input an average annual increase in tuition and an average annual increase in your supply costs. All right, now we have to set up some of the timing assumptions for the school. So the first thing we need to do is say what month of the year is the school start. And so if we put month 8, that means that the school year will start in August, month 8 of the year. And the last calendar month of the school year, if it's May, that'd be month 5. And so that shows that, hey, we've got 10 months of school year here. And then what we need to do is put in some timing related to payment as well. So we want to say first payment is due, again, in month 8. So this would be the month that students are required to make their first payment if they're paying monthly. and then when they're supposed to make their last payment if they're paying monthly. Now we need to do the same thing for those that are paying by the semester. So we have the ability here to allow students to pay monthly, by semester, or annually. And so for the semester, we're saying, hey, students need to pay the first semester by month 7 and second semester by month 12. And then if they're paying annually, they need to pay the whole thing up front in month 7. So kind of before the school year starts, right? Okay, so now what we can do is put in our different programs. So we've got preschool through high school. We can put in what category each of those are in, what month they start here. So we're saying all of these are already operational. We're starting in month 1 because we're assuming this is an existing school. And then the average number of students per program. So we're saying we have 25 students in preschool, 100 in our elementary school, 25 in each grade 6, 7, and 8, and then 100 in the high school. And now this allows you to say, if let's say you're starting a new high school, and ultimately you think you're going to have 100 students there, but you think it's going to take you 12 months to kind of build up to that 100 student level, you could enter in 12 months or 6 months if you think it's going to take 6 months to kind of build up to whatever that average is going to be. This will kind of space that out and pace the enrollment growth there. So, but again, we're assuming you're an existing school, so we're just going to put month 1. All right, now what we need to do is know what percentage of students are paying monthly, by semester, or annually. So we're saying that 20% of all of our students are paying monthly. And if they pay monthly, here's the rate that they have to pay. So $1,300 for the month for the preschool program, $1,600 for high school. And then we could have different, the reason we break this down is we might want to have different rates. So if you pay monthly, we might charge you a higher amount, and maybe we give you a discount if you pay more upfront for the semester or annually. So we say 50% of students are paying by the semester, so we have a different semester rate. And then the remaining 30% of all students are paying annually, and here's the annual rate. And then the last couple things we need to do on this tab is enter in this number of students per one instructor that we can have. So this may be regulated in your state, especially for probably preschool. You may have some specific rules about ratios that you need to keep, and so that's what we're trying to get at here. And then here is this gives you the ability to say, hey, we charge the students above and beyond, in addition to tuition. We're charging them like a book or a supply fee. And then here's what it costs us, the school, to provide those books and supplies. So we're charging the student $250, and we're paying $150 to get the books and supplies that the student bought. Okay, so that's revenue. And now we have the ability to kind of do this whole section again. And the way we do that here, we've got this input term type 2. And so what we are doing here is we're saying, hey, what if we had a summer camp in the months in between, right? And so what we've set up here is a summer camp that starts in month 6, and it's at elementary school, revenue category, 150 students per program. We're saying that all students, 100%, have to pay all up front when the program starts. So that's a way to enter in kind of additional, maybe non-typical, like your traditional tuition or school programs. You could also use this section for like maybe an after-school program that students are paying for as well. You could add in here. Okay, now let's go to our input other expenses here. And what we need to do here is you can enter in your different fixed expenses, categorize them. What month does the expense start? So again, since we're an existing school, we're assuming all these expenses are kind of ongoing. We have them starting off right in month 1. And then you just put in a dollar amount of what you expect in a typical year. Okay, so I've just put in kind of the same dollar amount across each month throughout the year, kind of spread it out evenly. But if you wanted to say, hey, we know our utilities go up a lot in the winter, and so we are going to kind of increase that more in the winter, decrease it in the summer type of thing, or in the spring and the fall. You have the ability to do that. And then what will happen is in future years, the model will just follow that same pattern. So if January is 15,000 for utilities, but maybe April it's more temperate and it goes down to 10,000 because you don't have to heat the building as much. Well, then the next year, what it's going to do is it's going to increase all of your numbers by whatever percentage you put here. So it's going to increase it by 3%, but it's still going to follow that seasonal pattern. All right, so that should help you kind of with your cash flow expectations. We also have what we call scaling expenses down here. So if you want to just put in expenses that are more of a percentage of revenue, an expense is a percentage of revenue or a per FTE. So if you have certain expenses that for every employee that you have, you're going to have maybe $100 a month fee for, I don't know, you give them, you're in the city and you give all the staff a parking pass and it costs $100 a month or something like that. That could be an example of a per FTE expense that you could build in here. And the model would just check to see how many staff are you forecasted to have in a particular month and automatically add that $100 a month to your expense line item. All right, now on our, moving on to our last input tab, our salaries and dividends tab. All right, so again, this is a little bit complicated for schools because you have the ability to pay faculty and staff in different ways. So some schools may say, hey, we're going to let you decide whether you want to get paid equally, your salary equally through all 12 months. And so we've got a payment period name here of 12 months. We just put an X in each month that the staff member is going to get paid. So if that staff member is categorized here, we'll look at it right down here. So we've got this category, 12 months, school year, or summer only. So for example, the principal says, yep, I want to be paid equally across all 12 months. Okay, and it's just going to take their annual salary of $100,000 and split it evenly between all the months where there's an X listed here, okay? And then maybe some teachers opt to be paid only in the months that they work, or maybe the cafeteria workers or custodians, that sort of thing could maybe only be paid during the school year, and when school's not in session, they're not paid. And then you may, again, have some staff that are only in the summer, only paid in the summer. So we give you that flexibility to kind of model that cash flow for payroll purposes. And then what you can do is you enter in all of your different employees here, and this first table is employees other than classroom instructors, and select what payment period type they'll have, what their annual salary will be, the employer portion of their taxes, cost for benefits, what month this position starts. So again, since we're an existing school, we're saying they're all current employees, they're all starting in month 1. If you have future employees that you plan to hire in the future, like let's say we don't have the summer camp staff yet, we're going to hire them in month 5 before the summer here. And then the last thing to point out is that you can select what number of that particular type of employee do you have. So let's say we have 5 classroom assistants and maybe 3 custodians. Maybe we have 1 in each school building. Maybe we have one school building for preschool and elementary, 1 for middle school, and 1 for high school, as an example. All right, and now we're getting to the classroom instructors or the teachers here, where we can add individual instructors here, pick their payment period again, their annual salary, and all that. So you can enter in your teachers manually this way, if you'd like to. But we also have this general instructor section down here. And so if you remember, back on the input revenue tab here, we said we can have 15 students per 1 instructor here for the preschool, right? But we have 25 students in the preschool. So based on that, the model is going to say, hey, you need 2 instructors for preschool. And then based on you have 100 in elementary, 100 students, and 25 students per 1 instructor. So we know we need 4 instructors for the elementary school. And so what's going to happen here is the model right down here is going to say how many total classroom instructors are needed based on those different ratios and the assumptions that you put in. So it's going to say, hey, we know there's 13 that are needed. But based on this table, we have these 3 instructors, but they don't start till month 8. Okay, we entered in month 8. So what does the model do? It says, well, specific classroom instructors entered, there's 0 right here, and then we can see these 3 show up here in month 8 because we entered them in right up here. So then the model is going to say, okay, well, we need to add 13 instructors because they're required to have these 13 instructors. And then once month 8 hits, well, okay, we added 3 manually. Well, we still need 10 to fill the gap. And so what the model does is says, whatever number this is, general instructors needed, it just takes the salary, the average salary that you put right here, along with the taxes and benefits and all that, and just applies that for all 13 general instructors you need, or all 10, or whatever it is. So essentially what that does, it just makes it so that you can't accidentally have less teachers than you're required to have in the model, and just kind of keeps you on the straight and narrow there. All right, and so once you're done with that, we are back to where we started on the at a glance tab. And I think the key thing that you'll want to look at for a school is really this cash flow statement broken down by month. And so you'll get to see that, hey, we started with $1 million, but we draw that down down to month 7 at the end of the summer. We have $344,000 in the bank, but cash from revenue, we get paid by a bunch of our semester and annual tuitions, and we can see our cash balance jumps back up in month 8. So the hope here is that once you enter in all your assumptions, you'll be able to really dive into the cash flow impact for your school on timing. And this can help you figure out like how much of a discount should you give if people pay upfront, because maybe that really helps your cash flow, and so you want to be able to do that. You want to have people pay upfront. You can play around with those different scenarios. If you don't need the cash as bad, maybe you want people to pay monthly and pay a higher price per month. So with that, I'm going to follow through on my promise to give you a coupon code. So down in the description of the video below, there is going to be a link to a form that you can fill out, and you will be sent our most up-to-date coupon code for this template. And then when you click the link that's also in the description of the video below to actually purchase the template, during the checkout process, you'll be asked if you have a coupon code, and you can just fill out that coupon code and take that discount on us as a thank you for sticking around through this video. I know it's pretty detailed. There's a lot here. And so again, if you have any questions at all as you are filling this out, you need some help, please don't hesitate to reach out to us. We'd be happy to try to help you build a cash flow model for your school. So you can reach out to us at support@projectionhub.com, and we'll do our best to help. Thanks.